Before we begin, let's walk through our webinar platform together. Each of the buttons at the bottom of your screen relate to sections in the ON24 console. The speaker view is where you will see our presenters throughout the webinar. The slide view is where you'll see the accompanying slides. Our poll questions will also appear in the slide area. Be sure to click directly on the slide to answer poll questions throughout the webinar. You can resize these widgets for a larger or smaller view. You may follow along also with a PDF version of the slides that can be found in the related content widget. The CPE criteria section details the requirements you must meet to receive full credit for CPE in this session. To obtain CPE, you must do two things. First, be on the live webinar for at least 50 minutes, and second, respond to 3 of the 4 polling questions that will appear throughout the presentation. You can track your viewing progress in this Earn CPE widget on your screen throughout the webinar. By registering for today's event, you will automatically receive an email after 24 hours with a link to download the slides and a link to view the recording. Additionally, if you meet all the criteria and qualify for CPE, a link to your CPE certificate will be in that email as well. Please remember that it does take 24 hours for that email to be automatically generated, so look for it sometime tomorrow afternoon. For CPE-related questions, please reach out to cpe@yptc.com. In the related content section, you can access any accompanying materials for this webinar. This includes a PDF copy of the slides and many times will often include related resources. Reactions from our audience throughout the webinar will float along the console screen. Use the Q&A section to ask questions directly to our speakers throughout the presentation. In the speaker bio section, you can find more about our presenters, including their contact information. If you need technical assistance, please use the help button below. Many times, technical issues can be resolved by opening the webinar in Google Chrome or refreshing your browser. Finally, the evaluation button contains our post-webinar evaluation survey. Here is where you can share your commentary and feedback on the presentation. We hope you enjoy our free webinar. Now, let's get into today's topic.
Hello and good afternoon. Excuse me, my name is Carol Santelli. I'm a manager here at YPTC. And this is my colleague, Jen Blasi. And welcome to Spotting Financial Risks in Not-for-Profits. We're grateful for you to be here today with us, and we look forward to sharing our insights with you. In my experience, I have worked in public accounting for more than a dozen years. I was in the mortgage industry, the real estate industry, before I returned to my roots supporting not-for-profits as a consultant, fractional CFO, and controller. My path eventually led me here to YPTC, where I've been for the past 6.5 years.
And I am Jen Blasi, another manager at YPTC based in the Philadelphia area. I started my career in public accounting as an external auditor, and I've worked as a forensic accounting consultant, and I've also worked as a non-for-profit controller and CFO prior to joining YPTC. I want to take a quick moment just to tell you a little bit about your part-time controller. We are a professional services firm that has specialized in nonprofit financial management for over 30 years. And our goal is really to help our clients sleep at night. We provide services such as fractional CFO, controller, and bookkeeping support, and we help organizations tell their financial story and implement best practices. We currently assist over 2,000 nonprofits out of our 13 regional offices, as well as remotely throughout the U.S. So, as I'm sure you can imagine, with our collective experience, we have become very familiar with today's topic of spotting financial risks in nonprofits. Carol, you might be muted.
Sorry about that. Okay, today our learning objectives are to 1, identify common financial and operational red flags in not-for-profits, and to 2, apply a framework of questions to understand those red flags and to mitigate the related risks. Martha, I see that. Go Birds.
I was just going to say, it's like watching the Eagles parade all over again. Carol's bleeping herself out already. So here we go.
All right, so let's get into our first poll question today. This is one of those poll questions where we would like to know who's with us today. So tell us a little bit about who you are. Are you a board member, a program or development team member, executive director or CEO, finance team member, an auditor or consultant, or other? So if you don't find yourself in one of those other categories, just click on other and you can tell us about yourself in the Q&A. Excuse me. while we're waiting for all those responses, I think you need to just scroll down to the end in order to submit. So if you don't see where the submit button is, just click down and scroll down and you should find that. While we're, again, waiting for everybody to join us, you can note that you can look forward to hearing from, we look forward to hearing from you in our Q&A. You can put your questions in there and we'll do our best to get to all your questions. We have about 84% submitted. Jen, I think we can move on.
All right, let's take a look at the results.
All right, it looks like, wow, 57% of you are on the finance team. That's awesome. It's good to see some board members in here too. Fantastic. All right, so let's jump right into it. As we start our presentation here, I want to emphasize that when we talk about financial risks, we're talking about red flags that can impact your organization. And what do we mean by that? What do we mean by spotting red flags? Red flags are critical warning signs and indicators of potential risks. That definition should seem practical enough. As you continue through the slide, you'll see what could indicate those issues related to a red flag. We talk about financial statement misstatements. We talk about fraud, compliance. The bottom line is that red flags often lead to financial trouble when they're not addressed. A key step to identifying red flags is regularly reviewing internal and external financial statements and related information. You're going to hear us reiterate that throughout this presentation. If you're not doing that now, that's the first thing you can put on your list of takeaways from our presentation. So as I mentioned earlier, identifying a red flag is important for everyone that was listed in our poll question and repeated here on this slide. Each of you has a responsibility to identifying those financial red flags. We highly recommend a process for every member of the organization to identify and remedy red flags before the auditors come in and discover those red flags. So for the board members in the group here, if you've ever attended one of our board training webinars, you know that the board members have a fiduciary responsibility to every organization you represent. And part of that duty includes ensuring the not-for-profit's financial health. One of the ways you do this is by reviewing financial statements on a monthly basis to evaluate the financials, the organization's health. As for the organization, the not-for-profit management team, which is 3 of the bubbles on our slide here, you need to be aware of those potential financial red flags or warning signs to avoid financial distress. Again, regularly monitoring the financial statements helps identify those trends, red flags, and opportunities to mitigate in a timely manner. The auditor's role is to plan and prepare an audit, exercising a healthy degree of skepticism. Where it's the auditor's responsibilities to call out an organization if the red flags are identified, it's on the management team and the board to prevent the red flags from interfering with the effective and ethical operations of an organization. So here I've discussed the who, we've talked a little bit about the how. Jen's going to get into the why.
Thank you, Carol. So it's critical to address red flags to avoid inaccurate financial reporting, compliance issues, and financial instability. And it should be obvious, but relying on inaccurate financial information, whether it's internally by the ED or the board, or externally for the audit or by your funders, it can lead to poor decision-making, loss of trust, audit challenges, and even potential reputational damage. And I see a question in the chat here with someone asking about quarterly financials. And you'll hear us talk quite a bit today about the importance of regularly reviewing your financials as often as possible to help you identify trends. With respect to compliance, nonprofits have to adhere to strict regulatory requirements, and those can include IRS Form 990 reporting, state mandated audits or reviews if you fundraise above certain thresholds, and a hot topic these days, complying with new executive orders. So addressing red flags timely can help you avoid penalties, fines, loss of funding, and possibly even loss of your nonprofit tax-exempt status. Finally, with respect to operational sustainability, ignoring red flags can disrupt your programs and threaten your long-term sustainability. So it's really essential to proactively address risks before they escalate. So let's talk about what to do when you spot red flags. And the simple answer is act immediately. Red flags are cues to take action. And so we've listed at the top here what we think is most important. Ask questions. You want to dig deeper, investigate further, and really figure it out. So we encourage you to use professional or healthy skepticism, and that really means critically questioning and evaluating the information that you are looking at. That will really help you spot red flags. And then you'll implement corrective strategies to mitigate the risk. Sounds pretty simple, right? So we're going to show this process in action in the next section.
It's very likely that you may be staring at red flags without even knowing it. Some warning signs may be obvious, but others can be easy to overlook. So let's get into more detail about how to look for those red flags. Here's a very basic overview of significant and yet common financial and operating risk areas that we believe are critical for everyone's focus. These are the areas where you want to pay close attention to the red flags. We've also listed where you can find those red flags if you're reviewing financial statements and other pertinent documents. It shouldn't be a surprise to you that cash is almost always the most critical topic for not-for-profits. So naturally, that's where our focus is going to be today. We find, or at least first anyway, we find cash on the statement of financial position. You'll note on this chart here that we use acronyms. You'll see those acronyms used throughout our presentation today. We'll also review some liabilities and net assets situations that could also indicate red flags. We'll touch upon the risks you may find on the statement of activities and the statement of functional expenses. Specifically, we're going to look at concentrations of revenue as well as expense allocations. Lastly, we'll cover some red flags related to audits, Form 990s, as well as governance and oversight. Anytime you are regularly reviewing financial information and using your professional or healthy skepticism to look for the red flags and risks, we encourage you to apply a 3-question framework. First, are there any red flags? We're going to talk about some of those questions you should be asking. If so, if there are red flags, consider the implications of the risk. And finally, discuss the suggestions for mitigation of the risks. Let's put some of this in action and jump into our first section, which is cash management.
All right, so here is how this section's going to work. I'm going to present Carol with a series of scenarios from a sample cash section of a statement of financial position. And I'm going to ask her if she spots any red flags. We'll discuss the risks and then discuss ways to mitigate those risks. For the record, all the examples we're using are illustrative purposes only. These are not real nonprofits. And many of our examples are exaggerated intentionally to help us get our points across. So with that, Carol, I'm presenting you with the cash section of ABC Nonprofit's Statement of Financial Position for 3 calendar year ends. I want to first note a few things. This isn't the typical way information is shared, right? So usually an audit is only going to show 1 or 2 comparative years. Internal reports may also not be comparing more than 2 periods. But in this example, let's assume the finance team created this internal management report to compare 3 year ends so that trends could be analyzed. And I'll also note that a statement of financial position also typically does not break out restricted cash from unrestricted cash because it may not be required. But it sure is helpful to track for internal reporting, and so I've included that here for you as well. And please also overlook the amounts are round dollars. Yes, that's not typical. It could be suspicious typically, but we want to be focused here on just the concepts. So let's just assume numbers have been rounded. So don't give me any of that in your answers. So with all those disclaimers in mind, what would your approach be to reviewing this information and identifying red flags?
So first, let me just say that when I look at a set of financial statements, whether it's an audit package or the internal package, I read every set of financial statements like a board member, again, regardless of my role. I expect that the executive director or the CFO should be able to answer my questions in the moment or follow up with me pretty quickly after doing some research. At a quick glance, there are a lot of red flags that stand out to me in this presentation. My approach is that I tend to ask questions about the things that pop. So let me start with, where did all the cash go? How did this organization have negative cash and no one noticed until now? Was anyone analyzing the downward trend? How is the not-for-profit going to be able to sustain itself going forward, specifically with negative unrestricted cash or operating cash? How will the not-for-profit be able to cover its day-to-day expenses like payroll, rent, utilities? Let's jump into the other cash, the restricted cash. What happened to all of that? Did they lose program funding? How will the not-for-profit be able to continue providing program services and carry out its mission?
So that's a lot to unbundle, or as we Eagles fans may say, unbundle Ruski. So basically, you're saying this entire screen is a red flag. So that was really astute of you, having just seen this for the first time. So good analysis.
Just for the first time.
First time
yes.
ever. So let's start with the first question you threw out. You asked, where did all the cash go? So what do you suggest doing to get the answer to that question?
So the first thing I'm going to suggest is looking at the bank reconciliations. Let's make sure that there's nothing nefarious going on. There's a significant decrease in cash resulting in negative cash balance on the general ledger. Could there be fraud?
Hang on, Carol. Why does your mind immediately go to fraud?
It concerns me that in 24 months, the organization depleted the cash asset of over $875,000, right? So the negative total cash at 12/31/24 is, to me, a glaring red flag, and it should be to everybody. My healthy dose of skepticism would immediately wonder why and how this organization that, again, I've never seen before, went from $875,000 in cash to a negative $6,000 in cash, and no one noticed. Negative cash should trigger a knee-jerk reaction to ask why and how.
Okay, so I get it. Your mind goes to fraud first rather than anything else.
Well, not anything else. It's just that that would be my initial thought. I would then start to question the reconciliation process and the list of cash transactions impacting the balance. So are all the deposits recorded correctly? Are all the checks and ACHs recorded correctly? To your point, Jen, instead of fraud, maybe it's a timing difference. Maybe the bank balance reflects a positive balance, but the cash on the general ledger is negative because of outstanding checks written on 12/31. So that would prompt us to say, is it a timing issue? Is it a short-term timing issue that maybe the scenario then tells us to look at the January, the subsequent month activity?
All right, so let's assume instead that there are no recent bank recs to go to. So you ask your question, you're told the bank recs haven't been, or the bank accounts haven't been reconciled in months. I mean, we've never heard that before, right? So what would you do then?
Excellent point. Then the negative cash balance could also be indicative of the bank accounts not being reconciled properly or timely. And we have seen this on occasion. This is an internal control deficiency. This is something the auditors will definitely identify as a material weakness, which will be reported to the board, and it could possibly be reported to your funders in the case of federal funding. It's critical for organizations to reconcile their banks and other accounts regularly, to ensure that they were reporting balances accurately and identify any cash issues timely. So if that isn't happening, that needs to be done as soon as possible, and the organization should adopt this immediately.
Okay, so let's assume no fraud, bank accounts are reconciled timely and accurately, there's no timing issues, and the issue is really that the organization blew through their cash and they're truly overdrawn at 12/31/24. What would you say then?
That brings me back to one of my original questions. How is it that no one noticed until now? Was anyone analyzing the downward trend? In the example that we were looking at, we had 3 years of information. So it made it easy to identify some meaningful trends. One of the first things I noticed was the trend of the significantly declining total cash balances. So I would emphasize that the trend depicted in this example is something that should have been identified in fiscal 23 when the organization's cash decreased over a third or 300,000. So again, in this example of how this is, I should say an example of how on a regular basis of reviewing reports, this would have popped, that red flag would have popped sooner than fiscal 24. And to be clear, the red flag that we're talking about is sustainability. So in your everyday life, we would hope that the finance team, at a minimum, is comparing balances at each month end rather than each year end. This is another instance where the organization needs to address the issue before the audit, because the auditors are certainly going to hone in on this, potentially explore a going concern opinion, or at a minimum, have those sustainability conversations with the not-for-profit.
So what I hear you saying is with this downward trend of cash, the nonprofit must deal with longer term, bigger picture issues of how to get the cash trend going back in the right direction. So what actions would you suggest this organization take to be able to sustain itself?
So again, going back to my original list of questions, we have to understand what really happened here. We need to understand so again, this is my approach. I tend to look at, when I look at the impacts of the unrestricted and the restricted cash, we should consider an approach of the statement of activities, an analysis of the statement of activities, and look at the changes in revenue and expenses. Did the not-for-profit lose or not raise enough unrestricted support? If so, why? Did the not-for-profit not generate earned revenue? Again, why? You'll see that I tend to follow up my questions with a why. It's my super question that gets to the heart of the issue. The same question applies to restricted funding. Did the not-for-profit lose grant or program funding? And again, why? What is it doing to get more funding? I would look at the highest expenses, usually salaries, because that's the biggest expense. Is there a significant increase? And again, why? Or did they take on a large capital improvement project or capital campaign that depleted the operating cash? This activity is typically on the statement of financial position, but some organizations record that on the statement of activities before making the appropriate adjustments. There may be more questions to ask. The point is to ask them and get answers. Once you know what the issues are, you need to develop a plan for sustainability. I would suggest 3 areas of concentration: raise more funding, decrease expenses, and get access to cash in the interim.
I mean, I thought I was the one asking super questions here, but let's take first one by one. So how can the nonprofit raise more funding and increase its revenue?
So they should explore opportunities with other foundations, private donors. They should develop a fundraising and development plan. I would also recommend revisiting their long-term strategic plan if they have one. What's their mission? What are the programs that they want to carry out? And if they don't have a strategic plan, they should develop one.
So what about the expense side? You mentioned that they should also decrease expenses. Can you give us some suggestions about how to do that?
Develop a cost-cutting plan, and that often includes staff reductions since, as I mentioned, payroll and benefits are often the largest expense.
So that sounds like all of that could really take a while. So what can an organization do to access cash in the meantime while they're trying to grow their revenue and reduce their expenses?
So Jen, you're going to love this. It starts with asking more questions. Does the organization have an investment or savings that they can access or draw from? Are there receivables or pledges that they can collect? Does the not-for-profit have access to a line of credit and get the board to approve a drawdown? Does the not-for-profit have the ability to borrow or get a loan from its bank? Can the board members or other donors step up, give sooner, give more? Can a not-for-profit delay their spending, such as for capital improvements?
All right, let's take a step back. So you started your line of questioning in response to my line of questioning by talking about the downward trend in cash being a red flag. So can you tell us some best practices for nonprofits to do to be able to recognize these trends before it's too late?
So I'll mention it again that in this example, we're looking at a calendar year-end set of financials. If this were a real-life scenario, the board and the management team would be blindsided by the lack of cash resources. It can't be stressed enough how important it is for management and the board to be looking at their cash position and their forecasts on a regular basis, not just a fiscal year-end. As we show here, it's best to look at more than 1 or 2 periods to identify those trends. You want to identify cash flow problems immediately and monitor them throughout the year. In addition, I would recommend that the management and the board should be comparing actual to budget on a regular basis and investigating those significant variances. If these practices, again, are not in place, you should be implementing them as soon as possible.
All right. Well, that was a lot of red flags that you were able to identify so quickly. So thank you for that.
Sure, but I actually have one more.
What else could you possibly see wrong here? I mean, this organization had positive cash balances at 12/31/22 and 23.
Yes, they do have positive cash. In fact, if we look at 22 and 23, as you mentioned, this not-for-profit is reporting total cash in excess of $250,000.
So wait, you just talked about red flags being that they don't have enough cash, and now you're saying it's a red flag if they have a lot of cash? Sounds to me like you're saying cash is a red flag no matter what.
Not exactly. We want to point out that I wanted to point out this red flag because these bank balances exceed the federally insured limits known as the FDIC deposit insurance. The FDIC adds together all the bank accounts in the same bank of the same organization when determining if you're in excess of the limit. So you can have as many bank accounts as you like, as we note here in our example, but if they exceed $250,000 in total, you're in excess of the FDIC insurance. We've seen a few banks in the past few years. That we've had some bank failures, and so this topic is very relevant. It's important for not-for-profits to remain aware of this risk. To complicate matters even further is if these are donor-restricted funds, the risk then gets compounded. So in the scenarios presented here in this slide, there would also be a required footnote that identifies and discloses the risk. So that should be even more reason for the not-for-profit to address the risk.
So what would you recommend they do to address this risk?
So in 22 and 23, we can see that, again, the total account balances exceed, there are $875,000 and $575,000 in excess of the 250. The not-for-profit could mitigate the risk by diversifying the bank institutions they use. They could transfer balances exceeding 250 into other different FDIC insured banks to keep all the bank balances below 250, or they could research bank institutions that offer FDIC insured sweep accounts.
So basically, you're saying this entire scenario is one giant red flag.
Unfortunately.
All right, I'm going to give you a different scenario then. So this time, I'm going to carry forward nonprofit A's cash section from 12/31/24 from the last slide. And I'm going to give you the rest of the assets section of a statement of financial position. And I'm going to compare that to 2 other organizations. So with this additional information, do you spot any other red flags here on the fly?
I do. So none of these not-for-profits have savings or investments. This is a red flag because these organizations may not have a safety net to cover unexpected costs or cash flow shortfalls. As we've mentioned in the previous slides, when an organization has declining or negative cash flow, one of the mitigating strategies would be to dip into the savings or the investments.
So if the organization has nothing to fall back on, what should they be prepared to do?
So for not-for-profit A, we have reflected and discussed their cash flow issues previously. So I would just say there that they need to get a line of credit immediately. For B and C, there are different scenarios. From what we can see here, B and C have no savings and investments, as we've noted, but they do have positive cash balances. We would need more information to know how long that cash could fund their operations. Hint, hint for another slide. But in the meantime, these not-for-profits could consider adopting an investment policy with their board. The not-for-profit could consider talking to an investment advisor about investing some of their excess cash into interest-bearing or income-generating investment accounts. B and C boards could also consider implementing a board-designated operating reserve, which transfers unrestricted operating monies into a separate interest-bearing account or investment account. And that money is set aside, again, as a reserve. It would be voted upon by the board. The reserve is often established to support future rainy day expenses like a new roof or an expansion of a building, or covering expenses when the contract funding is delayed or in doubt. Current events today is a great example where we've been discussing a lot of these in these past few weeks, how the executive orders are throwing many of our federally funded organizations into a financial flux. A reserve may be a resource. We should note that this is different from a donor restricted funds. That's because a board designated funds are simply taking the undesignated funds that a board has voted to set aside away from operations. The distinction is board versus donor restrictions. Finally, I would recommend, again, line of credit for not-for-profits B and C as a fallback so that they have it available when they need it in the future. It's sometimes easier to get a line of credit when you don't need it than when you need it now. A line of credit provides an organization with a financial bridge to cover those expenses until other funding is received. It's meant to be a short-term solution. Line of credits are meant to be repaid timely.
Thank you, Carol. These are all really great tips. So it sounds like having savings, investments, policies, reserves, and access to a line of credit are all very important for nonprofits, regardless of their cash position. But you mentioned one thing earlier that I want to follow up on, that we may need more information to know how long your available cash can fund your operations. So I want to dig into that a little deeper, since that sounds pretty important. So here's a key metric that can do that very thing. It can help estimate how long your available cash can fund your operations, the days cash on hand ratio, or if you have the luxury, you could be looking at a month's cash on hand ratio. So this ratio requires gathering some additional information from your statement of activities and your statement of functional expenses. So we've provided the calculation here on the slide, and we want to just highlight that for nonprofits, it's important that you try to use unrestricted cash in this ratio, not your total cash, because you're trying to measure available cash on hand. And if your donors have restricted that cash, that cash may not be available to fund your operating expenses. You also want to exclude your non-cash expenses similarly, because we're trying to measure how long our available cash can fund our cash expenses. We would say a healthy benchmark would be having greater than 90 days of available cash on hand at a minimum. That gives an organization some cushion. And this is a metric that you should be evaluating regularly, since results less than 90 days could be a red flag signaling that you need to take action quickly. So let's take a look at an example using numbers to see this ratio in action. So here we have the same nonprofits A, B, and C. We're using their unrestricted cash balances because we had that information, and we've provided you with the expense information. On the right-hand side, we're telling you the source of where we got this information in our hypothetical example. In the interest of time, I'm not going to walk through the math, but just note we are backing out non-cash expenses here of depreciation, bad debts, in kind. If you have leases, you may also be needing to back out lease amortization. Here, we're using 365 days in our calculation because our example is covering a full year. But just note, if you're calculating this for a shorter period of time, you want to adjust your denominator accordingly. So Carol, looking at the results here, do you see any red flags?
So you mentioned, Jen, how the benchmark is 90 days. In this presentation, you make it easy to see that not-for-profits A and B are the red flags. Their ratios are the red flags. B is below the healthy threshold of the 90 days, and A has negative cash, so you would expect that the calculation would yield a negative result. For the ratios for A and B, they're indicators of potential cash flow problems since these organizations would not be able to sustain themselves for too long without additional cash flow, given the cash availability at this time, right? They need immediate mitigating strategies and an action plan. It should be noted that this calculation is capturing a moment in time. It's somewhat of a taking of the pulse so that the organization can plan accordingly.
All right, that brings us to our second polling question. So I could see in the chat, some of you are struggling to find it. So hopefully you've all found it by now. Again, I think you have to scroll down on your screen. You're going to click right on the screen to answer, and you might have to scroll down to submit. So I'm going to give you a few minutes here, but we'd like you to tell us, what is your organization's number of days cash on hand? If you're not sure of the answer, don't worry, just choose D. And then your homework for today will be go back and calculate it for your organization. See how you measure up against our benchmark. If you're not able to track your unrestricted cash separately from your total cash, you can still use this metric. It still will be meaningful. You just have to understand its limitations, right? So some of your cash, if it's not available, may not be able to cover some of those expenses. So I'm going to give you another minute here. I did see in the comments that someone also recommended looking at the liquidity footnote for cash flow in your audit. That's an excellent recommendation as well. That is a great place and a good source to go to in your audit. To also,
but it's only there for the audit, you know. It's actually there just for your audit. So this is something we want you to do routinely, you know, monthly. We have some clients who do this, you know, weekly. They just want to know, you know, where are they in a cash flow?
Yep. And it's just a metric. If you do it frequently, you can notice adjustments, changes, seasonality, all those great things. All right. So it looks like the majority of you have responded. So let's take a look at our results. Okay. So a lot of you have over 90, some not sure. So you have your homework here from today. Okay. Couple takeaway slides we're providing. We're not going to go through them. We hopefully have already gone through them, but you could go back to this presentation and take a look at these later. We're summarizing the red flags, the risks, and the mitigation strategies related to cash management.
So let's move through some of the other account balances on the statement of financial position where we often spot red flags, that being liabilities and net assets. As part of your regular review of the financial information, you want to pay close attention to the organization's liabilities. You may be looking at a red flag and not even realizing it. Some of these items may even be buried in the other liabilities section of your statement of financial position, which is another great reason to ask what is in the line items of your financial statement. So, for example, growing balances in your monthly payroll tax liabilities and your 403B and 401K benefit liabilities is a red flag that should be questioned. You should be asking the organization if they're in compliance with requirements to remit payroll taxes timely to whether it be the government, the state, local municipalities. The same concerns are with the retirement plan liabilities. The DOL requires that retirement plan remittances be received by the plan timely after the pay date. So organizations are encouraged to remit the payment within the week after payroll date. If any of these payments are not made, members of the board and officers of the not-for-profits could be held personally liable to ensure prompt payment, which is more reason than enough to ensure that these liabilities are paid. By the way, cash shortfalls are not an excuse to remit taxes and retirement plan liabilities. If you heard us discuss securing line of credit, you know, we've discussed it several times here today. If you don't see a line of credit on your statement of financial position, ask the question. It may be that they just haven't accessed it. They may not have drawn down on it. The end result is the same, though. If an existing line of credit is maxed out, it means that it's no longer a viable option for cash coverage. If a not-for-profit currently has a line of credit, it may be an appropriate next step for the board to approve an extension or an increase in the line of credit. The line of credit, again, is only meant to be a short-term solution. So if it's reported that a line of credit is maxed out, the red flag may be that the not-for-profit has no immediate plans to make payments on that line of credit. Okay, so let's take a look at our sample net assets section of the statement of financial position. Jen, it's your turn to ask to spot some of the red flags. So tell us what you notice.
So just from my quick review of this slide, I think my eyes go straight to the negative balances in total net assets at 12/31/24, as well as the negative balances in net assets without donor restrictions for all the periods you presented, as well as the declining trends in those line items. So those would be significant red flags for me, similar to what you talked about with cash. So I'd also want to know, is anyone monitoring this? Could anyone have caught this sooner? And I'd probably wanted to have sounded the alarms when it was clear that net assets without donor restrictions were negative and getting progressively worse.
So what are those resulting risks, Jen?
So sustainability, once again, is the obvious risk. Having negative total net assets means that your nonprofit owes more than it owns, and that's just not sustainable. So this organization needs to act quickly to turn things around. Net assets without donor restrictions, they're often referred to as operating results. It's a lot easier to say. So growing deficits in this category indicates that the organization has not supported its operations since prior to fiscal 22. And we've talked at length about mitigating those types of risks, and those same types of tactics would apply here as well as what we talked about for cash. Assuming, this is a year-end reported balance, I'd also be worried about a going concern opinion from the auditor. That's not good. Going concern opinion signals doubt about your ability to continue operating into the foreseeable future. And I'll also note that funders and creditors may become hesitant to engage with you due to reported financial instability, which is just going to perpetuate the problem. This organization could be forced to consider downsizing significantly, merging with another nonprofit, or even dissolving. So these nonprofits signal very serious problems, and being proactive is essential.
So it should be noted that all of these great steps take time. You mentioned that the increasing deficits in net assets without donor restrictions would be a red flag. Can you discuss some of the other red flags we're looking at in this net asset section?
Yeah, I think the other one that really should be jumping out to everyone is that, this nonprofit is supposed to have at least $350,000 of assets on hand at 12/31/24 to comply with donor imposed restrictions, but it only has 200,000 of total assets, and that's a huge problem. This would indicate to me that this organization may have misused donor restricted funds for purposes other than what the donor intended. So from an accounting standpoint, GAAP may require the organization to record and disclose a contingent liability in its audited financials, since the donor could require the nonprofit to repay the funds that were used inappropriately. And there can be significant legal ramifications for this. It could include legal action by the donor, or you may hear from your state attorney general. Nonprofit could also potentially lose its nonprofit or its IRS tax exempt status. So it's very serious, very doom and gloom, but it's why it's critical for nonprofits to be tracking their net asset categories separately, and regularly. So this is definitely an issue you want to make sure is resolved before audit time. And one of the possible solutions to mitigate this risk, because I know you're going to ask me that, Carol, would be for the nonprofit to go back to these donors and request that the donor release the restriction and repurpose the funding towards general operations. Sometimes donors are willing to do that. So again, example is clearly very exaggerated to help us make our points. It may not be as obvious in a real set of financials, but hopefully you're now aware of what to look for.
Very nice. Thanks, Jen. So once again, similar to the last section, we have summarized a list of risks, some of which we've covered, some others for you to think about, and also summarized the risk mitigation strategies for you to review. So with that, let's jump into our next section, which is the concentration of revenues and expenses, where we can spot some other red flags. So here we're showing the revenue section of a statement of activities of, again, a fictitious not-for-profit over a 3-year period. Jen, as we quickly look at this statement of activities, what's the big red flag that's jumping right out at you?
So one that I think is really relevant right now would be, this organization's heavy reliance on federal grants. It's its largest revenue source in each of the years presented, although it is a declining trend. But management and the board should evaluate revenue concentration risks before you get to the audit to allow time for mitigation, because you have to disclose these risks in your audit footnotes.
So concentration of revenue is tough in any of these revenue streams listed. You know, I said that it jumps right out at you, but this is an example of where maybe it wasn't so obvious. In this current federal funding environment and concern of the unknown, the concentration here is more critical. In any situation, how does an organization address the concentration of revenue?
So anytime you're dependent on a limited number of funding sources, you have to focus on diversifying. So look for more revenue streams, attract more donors, more funders, particularly unrestricted, right? That's what everyone wants. In this case, the fact that the concentration is in federal grants, that's a very significant red flag, given recent fluctuations in federal funding being frozen, unfunded, unfrozen, I'm sorry, and affected by executive orders. So it would be essential to stay informed and assess how these events and future events might impact the organization. And at the end of our presentation, we have a resources slide that has a link to the National Council of Nonprofits, which is a really great resource to stay current on related news here. And from there, you can find your local charitable association of nonprofits. In Pennsylvania, where we are, that would be PANO. So check out their websites, subscribe to their newsletters. Those are great ways to stay current and learn mitigation strategies. And the other thing I'd emphasize here is cash forecasting and scenario planning are really critical to addressing concentrations of revenue.
What are any of the other red flags you're going to spot in this example, Jen?
I think quickly, I'll just note that, you know, you have a declining trend of community support. Contributions and memberships are in a steady decline since fiscal 22, even though your earned revenue is going up. And so again, regularly reviewing reports, you want to notice this and address this sooner. And your mitigation strategies might include strengthening your donor and member engagement and diversifying fundraising strategies and again, revenue streams.
Thanks.
So this brings us to our next polling questions. I see a lot in the chat that we're still having a little trouble with polling questions. So I'm hoping you can find this. Our question here is, does your organization track the program expense ratio as a KPI? So here we are going to switch gears and look at expenses next. This should be quick and easy, yes or no. Hopefully if you can scroll down and find the poll question, you're gonna click right on your screen and then scroll down to click the submit button. I can see in the chat here, before PANO, the organization that I had mentioned was the National Council of Nonprofits. That's more of the national organization. PANO is our Pennsylvania local version. So every state, I think every state, most states should have a local organization. But if you start with the National Council of Nonprofits, you can get to your local resource. And they've been really on top of sharing news about what's going on in the world of federal funding right now.
And we're going to have those links at the end of this presentation. There's been a lot of great questions, and we have so much information. I apologize that we haven't been able to answer them as we've been going along. If we don't get to those questions today at the end of this presentation, we'll be sure to follow up with you and give you our responses.
Yep, and you can always download our slides, and an email should go out that you'll all get these as well, and as well as a link to the recording, which you can get on our website. All right, let's take a look at the answers here. All right, so the majority of you are not tracking the program expense ratio as a KPI. So let's take a look at that in more detail, because this is a key ratio that you can be tracking. Because if you're not calculating and tracking this, be aware your funders and watchdog organizations likely are, whether we like it or not. So again, you want to go to your statement of functional expenses for this ratio, because you're going to take your total program expenses, divide by your total functional expenses, and this is really going to measure how much you're spending on your core mission-related programs and services, as opposed to your admin and fundraising. So we want to emphasize there is such a thing as an overhead myth, and that is that nonprofits shouldn't be spending money on admin or fundraising, but that's really not sustainable. In order to stay competitive, keep up with technology, and to grow, just like any other business, you have to spend money on overhead. So if you haven't read the book or watched the movie Uncharitable, we highly recommend you do so. Carol, do you know what the percentage is that funders and watchdog organizations generally want to see from nonprofits for this ratio?
I do know. And funders and watchdog organizations typically expect to see a ratio of 75% or higher.
That's right. So here on the slide, I'm showing you a statement of functional expenses in percentages rather than dollars to save some time. You don't have to do math on the fly here. Do you notice any red flags?
So yes, the first is the inconsistent 3-year trend in the program expense ratio. That raises concern. I'd want to know why the fluctuations. Of course, my first thought is that the costs are being allocated incorrectly or inconsistently. This pattern indicates possibly issues with the allocation methodology, making this statement of functional expenses somewhat unreliable. 22 reflects the most realistic ratios and meets the best practices for the benchmarks. In 23 and 24, it seems unrealistic and frankly wrong. Program expenses have a 95% ratio in fiscal 24, and that just seems unrealistic. It's also unreasonable to assume that management and general overhead is only 5%. Though changes in management and general ratios can fluctuate, a reasonable level of overhead is necessary for organization to operate and grow. The fluctuating ratios may indicate potential concerns that the cost allocation process is not working correctly, that staff understanding of it is not quite there, and the process or the ineffective bookkeeping of when expenses are coded is not quite where it should be. So not-for-profits should be conscientious of the ratios, but managing to an outcome to achieve a desired number could also be problematic and raises ethical concerns.
I was hoping you were going to say that. Do any other red flags jump out at you while we're looking at this?
Yes, another red flag is the absence of reported fundraising expenses in fiscal 24. If an organization has received any contributions, it's likely that they've incurred some fundraising expenses as well.
Okay, again, we have some summary slides for you here to take away to summarize the risks and our mitigation strategies.
So we're going to jump into here audit and compliance. Some red flags that you'll see as part of the audit and the 990 process. But first, let's jump into our last poll question. Again, Jen's mentioned that there's been some concerns about not seeing it. There may be a delay. You need to scroll down. Our polling question here is, how long after your year end do you typically finalize your audit? You can pick one of these options here, less than 3, 3 to 6, 6 to 9, over 9, maybe you're not getting an audit, so it may not be applicable. I would suggest to you that you could also apply this to reviews and compilations, and we'll talk a little bit about that once we get everybody's response here. We're at 50%. I hope everybody's seeing the poll if you scroll down. Again, this is your fourth one. This is the last one of our presentation. We know we're running a little tight on time here. We're doing our best to get to the end. So let's see, can we get to any of the questions here while we're waiting?
I think someone had asked for the calculation again for the program expenses, and that's really you take your dollars, your total program expenses in dollars, and you divide that by your total functional expenses, which may be your total operating expenses, and you come up with a percentage. So you do that for each of your buckets when you report a statement of functional expenses, like in your audit or for your 990. Not as easy to do during the year, but you could still get a general idea of where you're ending.
And it was 75%. I saw a question about what's the typical percent regarding 75% for the program expenses. So we're at 81%. Did everybody get a chance there? So 3 to 6 months seems to be the big number there. That's, I mean, yeah, that's pretty great because that feeds right into this next slide. So when we talk about this presentation, we're discussing, as I said, audits, but it could be relevant to reviews and compilations. If you're having an audit, when is the report dated? And you might be asking, why, Carol, does this trigger a red flag? So let me get into a little bit about that. Yes, it's best practice to have your audit completed within 90 days of your year end, but realistically, that's ambitious. Certainly, your audit should be completed before the first due date of the Form 990, which Jen's going to cover, or by the first due date of your funder, whichever comes first. So for this exercise, that's why we say possibly a red flag at the 6/30 date, because it's past the 990 due date. If the audit is signed and submitted on the last due date of the Form 990, which in this example would be 11/15, you probably have an issue. It's even worse if the audit is signed after the last 990 date. Why is it an issue? Let's try and get into that a little bit. So if an audit is late or dragging on, these 6 bullet points are a great place to start with your healthy dose of skepticism. Changes in audit firms year after year. Is the audit firm firing the not-for-profit, or is the not-for-profit opinion shopping? Was an audit never completed? Huge issue. This could delay in funding, jeopardizing the not-for-profit status. Was the delay due to the auditor's schedule, or was it due to management? Delays by the organization's management is certainly a red flag. For example, a lack of documentation causing delays in decision-making reflect poor staffing or weakness in internal control. Significant adjustments or audit findings, typically a red flag. It means the not-for-profit books are messy, which could be an indication that the staff doesn't have the technical skills or they're under-resourced. Other underlying reason for the delays in audit could be a red flag is ineffective governance. This all leads to the ultimate red flag, which is
ta-da.
Throughout this presentation, we've referenced a going concern opinion as a red flag. That's one of the, not so great opinions that you want to get from an auditor, right? So to be quick and to the point, anything other than an unmodified or unqualified opinion is a red flag. Any other opinion should prompt immediate questions.
Thank you, Carol. So we're going to move on to the 990, and I know we're running out of time here, so I'm sure that's very disappointing for people who love to hear about 990s. But very similar to the audit, filing dates for your 990 also can indicate potential red flags. Your audit really should be completed before the 990 because that information feeds into the 990. Schedule D on the 990 is actually going to show a reconciliation between your audited revenues and expenses to the numbers reported in your 990. Additionally, states can require your 990 and your audit get attached to your annual charity registration renewals. So you really want to make sure that you're getting these done timely. So if you have to file your 990 before your audit's complete just to avoid penalties and fees to meet that deadline, that's going to be a glaring red flag. And if you have to amend your 990 once your audit's complete, that is always going to be a red flag. The deadlines for filing 990s is a mouthful. It's the 15th day, the 5th month after year end. So in our example, that's May 15th. You can get a one-time 6-month extension. That would extend you to the 15th day of the 11th month after year end. So in our example, the last possible date filing on time would be November 15th. So filing timely is really, really critical for compliance. Filing on 11/15th, I would still view that as a red flag, even if it's on time, because I'd question what's taking so long to get it filed. Are the delays due to management, or is it really due to the preparer of the 990? And filing anything after the due date is always going to be a red flag. That also indicates poor governance. And you may be subjected to penalties, fines. If you don't file your 990 with the IRS 3 years in a row, that may result in you losing your tax exempt status. So really pay attention to filing dates. Your 990 is really an informational return, and boy, does it contain a lot of information. Reviewing your 990 before it's filed is really critical. Your board should be doing it. That's good governance. It can be a daunting task because there's a lot of information in there. So we want to just emphasize that you should look at it as a marketing tool and a way to communicate with your funders and potential funders, because this is a public document. And even if you don't have it on your website, funders are going to find it. They're going to get it on GuideStar or other watchdog agencies. So pay attention to what you're putting in your narrative in Schedule O. Take advantage, tell your story, explain information, promote your program achievements, and most importantly, you can proactively address any red flags that someone might note from your numbers or from the answers you've provided. On this slide, we've highlighted just a few key areas of note for your review. These are not the only important things to look at, but we don't have all day. So we just emphasized a few places where you may spot red flags. You can take a look at this when you download our slides later.
All right, jumping ahead because we have 1 minute left here. So for those who have to go, we understand. You will get these slides, so you'll have something to reference. Governance and oversight. This is really a review of everything we've discussed up to this point. The board in managing financial risks. The development of strong financial controls is critical to the governance and oversight in the prevention of risks and red flags. So strong financial controls protect your organization's resources and boost confidence among your stakeholders. We've identified all these red flags directly or indirectly throughout our presentation. Key takeaway, management and board members should be meeting often and reviewing financial statements regularly. The board should cultivate an environment where asking challenging questions in a board meeting is welcomed. Questions about unexpected budget variances, fundraising efficiency, the rationale for financial decisions, and potential financial risks can lead to more robust discussions and better decisions. Reviewing financial statements and having interactive conversations should detect everything we've discussed today, including items on this slide.
And that brings us here to the end. Again, we have a summary here of our learning objectives, spotting red flags, and a framework to address them. And we have a resources tab. Again, you'll get a copy of our slides. I think we are out of time. If we didn't get to your question, please reach out after this presentation. We want to thank you for joining us here today.
Thanks so much, everyone. Have a great rest of the day.